On the 23rd of August 2018, Manchester United plc became the first football club in the world to be worth $4 billion. We know this because their share price finished that day at a record high of $24.60 on the New York Stock Exchange, where the club's shares are publicly traded. Around the same time, there were rumours that Liverpool and Chelsea had been subject to takeover bids for about £2 billion, but the actual price is unknown because both these clubs are private companies. Many people queried the logic of Juventus signing Cristiano Ronaldo and whether the club would benefit from a €110 million transfer fee and wages for a 33-year-old player. But since joining Juve, the doubters have been proved wrong, as the club's value has more than doubled, from €600 million to €1.4 billion, as the market digested the impact that CR7 has on the global commercial desirability of the club with sponsors. In the 1980s and 90s, many clubs in the UK, as diverse as Spurs, Millwall, Southampton, Hearts and Sheffield United, changed their status from private to public. Within 20 years, the vast majority had reverted to being private companies, chastened by their experience of additional scrutiny and the costs of being members of a stock exchange. All businesses, including football clubs, need finance. Before the first ball is kicked and the first ticket is sold, the club will need to buy the land on which they play their matches, build a stadium, employ a manager and coach, sign players, and so on. Cash will only come into the club at a later date as matches are played, commercial deals are signed, and broadcasting rights are sold. And finance comes from two sources. Clubs can borrow either from banks, private institutions, or owners, or they can generate cash from issuing shares to investors. Prior to being acquired by the Glazer family in 2005, Manchester United plc had its shares traded on the UK Stock Exchange and was debt-free. The situation changed when the Glazers borrowed substantial amounts of money from financial institutions to fund the acquisition of shares from the market and take the company private. Because United was seen by lenders as being a risky investment, banks charged interest rates of up to 16.25% on the borrowings, and this has resulted in United paying out £767 million to banks since being acquired by the Glazers. The alternative to borrowing money is for a company to issue shares to investors. A share normally allows an investor to vote on key decisions each year, such as who are the company directors. There are broadly two types of company, although recently some clubs have gone down the third route of being community-owned. Public companies are able to issue shares to anyone through what is called an IPO, an initial public offering. The company issues a prospectus where it sets out its intentions in terms of a business strategy and budget. The benefit to the club is that it can raise money from anyone and everyone, thereby broadening the number of people who are willing to invest and raising more money. This money could be invested in the playing squad, improve facilities for fans, and so on. The benefit to shareholders of buying shares in a public company is that they can easily sell their shares on an open market and know the price of those shares day to day. The shareholders are not, however, involved in the day-to-day running of the club and are not consulted on strategic or operational decisions, which are delegated to the board of directors and the manager/coach. Therefore, if a fan thinks that buying 100 shares in their favourite football club will allow them to have a say in transfer, ticket price and away shirt colour policy, they're wrong. But there are significant downsides to being a publicly quoted football club. Firstly, the club is subject to greater compliance costs, as it's necessary to abide by the rules set down by the relevant stock exchange, as well as more complex and detailed company law requirements. Millwall estimated these costs to be about £100,000 a year when they made the decision to return to being a private company in 2011. Secondly, the club may have to answer to analysts and commentators in the media to a greater degree on its financial dealings. Analysts give advice to their clients as to which companies they should invest in, and so tend to want to know the intricacies of the football club's finances. The club directors may feel that this is a waste of time and prefer to focus on the day-to-day running rather than being grilled and observed with a keen interest by a bunch of bankers. Thirdly, the majority of shares in publicly quoted companies are owned by institutions such as pension and insurance companies. These shareholders have little interest in the club as a sporting institution. Their aim is to maximise a short-term financial return rather than the longer-term success of the club. And fourthly, for an owner, going public means potentially losing control of the club. The Glazers at Manchester United have prevented this by having two types of shares in the club. Class A shares carry 1 vote each and are the ones traded on the New York Stock Exchange. Class B shares carry 10 votes each and are owned by the Glazers. This allowed the Glazers to generate £140 million in 2012 by taking United public. Half of this was used to pay down debt, and the other half went to the Glazers. The A shares represent about 25% of the total number of shares in Manchester United, but carry just 3% of the votes. This allows the Glazers, provided they do not fall out with each other, to make whatever decisions they see fit without worrying too much about unhappy third-party investors. The alternative to all of this is to be a private company. Here, shares are not traded on a market and are not easily transferred from person to person. Most clubs have what are called preemption rights, where anyone wanting to sell must first offer the shares to existing shareholders before selling to a third party. Private companies usually have a single or a few shareholders, who are often board members too. As such, they benefit from not being answerable to outside parties, more relaxed company law and accounting filing rules, but the club has fewer methods of raising finance. When a privately owned football club makes a profit, which historically has been a rarity, those profits belong to the owners. The owners then have the choice of either reinvesting the profits back into the club or taking them out in the form of dividends. Now, very few owners have taken the dividend route. One of the most famous, however, was Blackpool in 2011, where after being promoted to the Premier League, owner Carl Oyston paid himself £11 million in dividends from the money generated that season. This led to huge subsequent protests from Blackpool fans who felt that the money should have been used to improve matters on the pitch. Manchester United, being a public company since 2012 and therefore at the will of the demands of the market, have paid dividends of over £64 million since that period. And that's why, if it's right for the club, a football club might float on the stock market. Speaking of stock markets, hundreds of professional players are available to trade on Football Index, the real money football stock market. Build your portfolio of players, and for the first 7 days you can trade up to £500 risk-free. So take a look at the link in the description, download the app and start trading today. Thanks for watching.